Thank you, everybody, for joining us on a Thursday afternoon before all the snow rolls into the eastern half of the US. We're going to be covering today some of what's been happening in the market, looking back over the past year, trying to kind of orient ourselves in terms of where we're starting from. We'll talk a little bit about the economy, kind of where we are in the business cycle, different measures that we're watching. And then finally, we'll talk about some opportunities or risks that we see in the stock and bond markets. As we get started, I'm going to require you guys to work a little bit. So if you could look at the bottom of your screen, there is a button. It might be evident, or you might have to click more. And it says Q&A and there's a box with a little question mark in it. If you get that open, here's a quick question for you. What was the best performing asset class in the fourth quarter of 2025? So generally, we track kind of, a consistent series of buckets of different types of asset classes. So think US stocks, non-US developed, could be Japan or Europe, emerging market stocks, investment grade corporate, so large companies who are borrowing, US high yield, maybe smaller companies who are borrowing, municipals, and then commodities or real estate. So we have here a vote for gold. Not on the list, but you're right, had an incredible year last year. Technology, semiconductors, commodities, US stocks, commodities, US stocks, storage stocks. No clue. That is a great answer. That's why I'm here. US large caps, emerging markets. Yeah, so a lot of great guesses and a lot of great asset classes that are in there. On the whole, though, commodities were the best performing asset class. And so gold makes up a proportion of this commodities basket that we're using here. Interestingly, commodities can be a little complicated to track because depending on what you include in a basket, you can end up with very different answers. So for instance, some commodities may not have much allocation to gold and silver, which did incredibly well in 2025. They might be more oriented towards agricultural commodities or say oil, which did less well in 2025. But in aggregate, based on this particular measure that we track on a regular basis, commodities were the best performing asset class in the fourth quarter. But really, like when you look at other asset classes, most asset classes did quite well, whether you're talking about stocks in the US or elsewhere, or bonds. The one kind of weak spot was US real estate. So these are returns just for the fourth quarter. If we back up and look at the whole of calendar year 2025, again, like a really good year for risk asset classes. Both bonds and stocks were in positive territory, and in fact, both commodities and real estate were in positive territory. What's interesting is that if you look at all those asset classes for the year, emerging markets did the best. And a lot of times when I ask this question, even folks who follow the market closely are not aware. Emerging markets has underperformed for many years, and so I think a lot of people have kind of started to forget about it. But those are often just the times that asset classes can kind of come back in favor. So it's been very interesting to see that asset class emerge. So let's take a quick deeper dive into sectors within the US. So here's another quick question. What sector performed the worst in the 3 quarters of 2025? So, in terms of sectors, you can think technology, communication services, healthcare, consumer discretionary, consumer staples, energy, materials. I think that's real estate. So I see real estate, housing, retail, healthcare, financials, staples. All right, the answer is healthcare. So a couple of you had that right. The first 3 quarters of 2025 were in healthcare. And so think about this. This is coming sort of after this big kind of Ozempic boom, where there were a number of healthcare companies that had done really well when that was first introduced. And of course, you have a lot of political change happening with policy around healthcare that really weighed on stocks as competition changed. But what's interesting is that in the fourth quarter, then, healthcare was actually the best performing sector. So this really interesting quick switch where healthcare went from the worst performer to the best performer. And without a whole lot of the fundamentals changing, like the policy environment hasn't changed overnight, but I think investors started to look at some of these companies that have really good earnings generation and say, okay, even though these risks are still there, I think these are good companies that can grow their earnings. You'll see over on the right areas like real estate, utilities, consumer staples. These are often areas of the market that investors retreat to during times of stress. And clearly, equity investors are not feeling very stressed because they're still willing to go into what we consider, somewhat more higher beta names like in technology and communication services. So let's take a moment to look at interest rates. So this has also been a really important driver. Over the last couple of years, I grew up, well, backing up, I grew up in this business with this idea of like, don't fight the Fed. What the Federal Reserve is doing is really, really important in terms of the direction of the economy and the market. So when we look at yields within Treasury bonds, you'll see that they differ depending on how long that bond is for. So this is what we call the yield curve. That dark line is where the yield curve started at the beginning of 2025. And then that light blue line is where the yield curve ended 2025. So as you start off, you see 1 month yields or yields on like 1 month bills. And then it kind of goes out so that you can see all the way at the end 10, 20, 30-year bonds. So typically what we call a normal yield curve, interest rates will rise the longer the duration of the bond. It makes sense. If you're having a loan for a longer period of time, whoever's lending you the money is going to want to be paid more for it. But you've had the Fed can have a really big impact on short-term interest rates. So what we saw here as the Fed started to lower interest rates more throughout 2025, those shorter term yields came down. But on the longer end of the curve, they were relatively steady, not a lot of change. So this has implications for all sorts of other bonds down the line. So with that, let's take a little closer look at what's happening in the economy. Now, there are any number of different data points that we can typically look at to help get a sense of what's happening in the economy. In the fourth quarter, that got a lot harder with the government shutdown because a lot of government created data was not available. And in some cases now we have holes, right, where government agencies decided to simply not go back for certain time periods and collect that data. That said, we've been able to fill in a lot of those gaps. There are also a lot of privately reported data where we're able to kind of keep track of what's going on in the market and the economy. So this here is what we call the dashboard. 5 main areas of the economy that we look at on a regular basis. Then we try to evaluate. Red, are things slowing down? Green, are they maybe picking up or even overheating? And the first thing to notice is that most of those like dials there are pretty much in neutral. We have housing, which recently went a little bit more into the red. We have monetary policy that's hovering kind of like right on the edge of green. But in general, that means like we're in a fairly neutral economy, which is usually a pretty good place to be. So starting first with a closer look at the Federal Reserve, the Fed's job has certainly been hard so far this year. Now, the Federal Reserve's job is often hard, but the uniqueness about the last year are because, number one, a lot of the indicators that they're looking at are giving them conflicting signals. And then number two, you have a lot of political pressure that is unusual. It's not completely outside of historical precedent, but it's an unusually high level of political pressure on the Federal Reserve members. So that complicates things. Here is sort of like the Fed challenge writ large. On the left, we're looking at employment indexes for both manufacturing companies and services companies. So when this line is declining, those companies are hiring less. So employment is contracting. On the right, what you see is prices paid. So it's those same companies, are they paying more or less for their inputs? And you see there across both services and manufacturing, prices are going up still. So this is the challenge. Employment is going down, which typically the Fed would lower interest rates and stimulate the economy, but prices are still going up. And typically when that happens, the Fed would actually raise interest rates to slow the economy down. So they're trying to navigate this and try to figure out which one to weight more. Over the last couple of months, as we've sort of like read into what the Fed is saying, they've begun to shift being more worried about inflation to being more worried about employment. And that has meant that they have been able to really bring interest rates down a little bit in order to stimulate more hiring. But it's been sort of a tricky dance. In the meantime, overall manufacturing has really been struggling to accelerate. So, think those same surveys that we just looked at earlier. This is a broader index, kind of taking all these companies' responses and rolling them up into one. Again, the gold line is services companies, the blue line are manufacturing companies. So over the last couple of years, you can see where manufacturing companies have been below that 50 line. That means that manufacturing activity has actually been declining. And we've had a couple times where it looks like manufacturing is starting to accelerate, but it's been hard for those companies to really see a sustained increase in activity. The services side, on the other hand, has decelerated a lot from a couple of years ago, but has remained in positive territory and even has accelerated a bit more recently. Part of that strength is thanks to consumers who are still willing to spend. So there's again like a sort of like interesting tension, because if you look at consumer surveys, so for instance, when individuals are asked, how do you feel about your economic situation or the overall economy? A lot of people are saying, I don't feel really great. But when we look at what they're doing, they are still spending. So this particular series is looking at retail sales. So how much money are people spending? But then we're taking out inflation. That's the real part. And then we're also taking out autos, only because that can make it very, very volatile. And so what you see there is real retail sales had hit a low when inflation was really high, right? So that's inflation eating away at people's ability to buy things. But then as inflation stabilized, those real retail sales started to increase again. So I would say overall, consumers are not spending tons of money, but we are seeing people be confident enough to increase their levels of spending. This also masks what you may have heard reference to, like the K-shaped economy. So this sort of masks that. The K-shaped economy is that higher end consumers are doing this. They're feeling pretty good. They feel like their jobs are pretty secure. They probably own a lot of stocks, even if it's in their 401k, and their wealth has increased. And so they're feeling pretty good and they're spending more. Then at the lower end of the spectrum, you have low end consumers who are maybe less secure in their jobs, have been more impacted by inflation, and are spending less. But in aggregate, which tends to be the one that has the biggest impact on the overall economy, in aggregate, consumers are spending. And a key component of that is how secure are people in their jobs. And so, as I mentioned earlier, this has been an area that was particularly difficult to navigate because of the government shutdown. And as it is, labor is a very difficult thing to kind of put a finger on. So typically we have a lot of different data measures that we'll look at and try to kind of put together to have a sense of the story. So for instance, how many people are entering the workforce? There have been periods of time when a lot of people just said, I don't want to look for a job anymore. Or people taking jobs that are maybe part-time when they want a full-time job. So at any rate, looking at all of these different things, we try to kind of get a feel for what's happening in the labor market. And in general, what we're seeing is that there are not a lot of layoffs, but some jobs are increasing, but we are seeing the unemployment rate increasing. So this unemployment rate is simply the number of people who are looking for a job divided by everybody who's in the workforce. And you can see that like pretty notable increase over the last couple of years. But then compare that to that red line, which is the average excluding recessions. So what that tells you is that even though the unemployment rate has been ticking up, it is still well below previous averages that we've seen. So again, that suggests that we still have a very healthy economy. This is something that takes a while to turn. So the Fed is going to try and anticipate where this is going to go because they don't want to wait too late. Another piece of this is thinking about what happens with small businesses. A large majority of jobs in the US are actually created by small businesses. But as you can imagine, they're very hard to capture, right? Because a lot of these have, like, say, fewer than 10 employees. So this is a really helpful index in order to help nail down how small businesses are feeling about the overall economy. And here you can see from 2004-ish, right? Small businesses are starting to feel much better about economic conditions, which suggests that they're going to be in a better place to be able to hire. So that's some positive momentum. In the housing market, I mentioned that that was one area that we had moved more into the red recently. So this is one measure looking at months of supply of existing homes for sale. So how many homes are on the market relative to how many homes are being sold. So currently you can see that tick down. That's largely seasonal. That happens a lot in winter. People will take their homes off the market. So I wouldn't read too much into that more recent number, but as of today, there's about 3.5 months of existing homes for sale, which means it would take 3.5 months to kind of work through that inventory. Now, this is heavily influenced by what's happening in mortgage rates. And so if we look there, the picture is a little bit more encouraging. So on the left, we have average mortgage rate going back to the 1970s. Pretty remarkable. I don't know how many of you remember this, but in 1981, if you wanted to buy a home, you had to pay about 18% interest. So pretty remarkable. A far cry from the low of like 2-ish% that we had during COVID. So if you compare current mortgage rates to kind of those lows that we enjoyed during COVID, they're well above. But so far this year, that chart on the right, we have seen some deceleration in mortgage rates, which has helped kind of prop up some housing activity. But we still have this like really tough affordability headwind in that many Americans can't afford a home. And that is something that doesn't get corrected overnight. I want to just touch on fiscal and government debt because this is something that has certainly gotten a lot of attention over the last year. And I like to call US government debt an American problem. If you sort of break this down by party, every party since I think it was Truman has increased the federal deficit. So it's been many decades in the making. But if you look at federal debt as a percentage of GDP, you can kind of see that just sort of straight up and to the right. Really peaked during COVID and has come down a little bit, but based on spending projections is expected to continue to increase. And then on the right, as we look at federal deficit, so this is how much is the government bringing in versus how much is it paying out. So the deficit is expected to continue to increase as well in a negative manner. So this is a headwind. This is not something that's going to be corrected overnight, but I think does at times have an impact, especially on longer term bond markets. Another important piece of the puzzle and has greatly influenced the relative attractiveness of different asset classes is the US dollar. So in 2025, the dollar declined by about 10%. So you can see that chart on the right, just looking at the calendar year 2025. And much of that decline came in the early part of the year. So if you remember, this is when tariffs were really coming to the fore. And I think there was a lot of repositioning in fixed income markets where people were leaving the US dollar into other major currencies around the world. Now, if you think back to that earlier chart where we looked at different asset class performance, non-US developed and emerging markets were the best two asset classes for 2025. This is partly why. So those markets did quite well in their own currencies, but then because the dollar is weaker, those non-US currencies look better, right? So you sort of had double whammy where this dollar weakness really benefited those stocks. All right, so with that, let's take a closer look at the stock and bond markets. And we have this great cartoon here, focus on AI, because again, that's where I get most of the questions these days. So what will be the impact of AI in our business? It's too big to put into words. Here's an image I created. It's a cheetah wearing a jetpack while inventing electricity and fire all at the same time. So how are we using AI? Mostly to create cool images like this. And in fact, this is hopefully this resonates with a lot of people, but we have a lot of data that actually show that's tracking the way that people are using ChatGPT and other AI tools. For, the first couple of years that these were available, that was exactly what people were doing. They were just sort of playing around with it and using it as entertainment. That is starting to change as we're starting to see companies really sort of like leverage AI, figure out how to use it, figure out how to make people more productive. But we are still very much in the experimentation stage and less so in the implementation stage. But let's take a quick look at how this has impacted different stocks in the market. If you remember, 2022 was a bear market, so most stocks were down quite substantially. But here we're looking at a number of different parts of the market beginning in January 2023 through the end of 2024. And that time period also coincided with ChatGPT first coming on the market. And you see NVIDIA there, who's essentially the exclusive provider of chips for AI engines. NVIDIA during just that 2-year period was up 800%. Absolutely remarkable performance. And you'll see the S&P down there was up 53% in 2 years, which itself is remarkable performance, but looks really dwarfed by that great run that NVIDIA had. You'll see some other areas, hyperscalers, so think like Google, Meta, Alphabet. Those folks also had really great returns, 3 times that of the S&P 500. Meanwhile, industrials lagged. And then we had semiconductors did well, but not nearly as well as their peer in NVIDIA. Fast forward to 2025, the picture looks a little bit different. So these are the same groups, but interestingly, you'll see that for the year, semiconductors actually did better than NVIDIA. So NVIDIA is also a semiconductor company, but they're essentially the only one who can build these chips for AI. Semiconductors, the group here is everybody else but NVIDIA. And they've been able to kind of stretch ahead of NVIDIA as they're finding their way into these markets as well. And then I'll just call out industrials as well, which went from a laggard to a leader. And they've been an important part of this kind of like build out of AI infrastructure, which we'll take a closer look at. But before we do, if you could get out your chat boxes again, here's a question. How many stocks in the Magnificent Seven outperformed the S&P 500 in 2025? So these are, let me see if I can get them all. Google, Meta, Alphabet, Apple, Tesla. Who am I missing? I'm missing somebody. Tesla, Google, Meta, Amazon, and Microsoft. So of those 7, let's see how many do we have? 2, 5, 2, 5, 3, all, 5, 3, all, none. All right, all over the map. Only 2 of the Magnificent Seven names outperformed the S&P 500 in 2025. NVIDIA was one of them, right? So this is coming after already extraordinary performance, but actually the best performing stock of the Magnificent Seven was Alphabet, with a return of 65% in 2025. And what that means is that the impact that these 7 names have had on the overall return of the S&P 500 has lessened. So if we look back to 2023, those 7 names drove 2/3 of the return in the S&P 500. So they were really, really important. They all had much better returns than the S&P 500. Going to 2024 then, those 7 names drove about half of the S&P's return, and then roll forward to 2025, and this is a little bit less than half. And so what you've seen is, as we looked at earlier, some other parts of the market that are starting to become more important. Now, again, the artificial intelligence theme continues to be really important, and thinking about what happens with CapEx trends helps tell us kind of where the market is going to shift its focus. So here is looking at the capital expenditures spent on artificial intelligence by these really large hyperscaler technology companies. And what we've seen is that the amount of dollars going towards this build out have been consistently underestimated. So in 2024, at the beginning of the year, if you asked analysts who focus on the market and these companies, if you asked them, how much do you think these companies are going to grow their capital expenditures next year? They would have said 19%. But these companies actually grew their CapEx by 54%. 2025, it was the same thing. Analysts were expecting only 22% growth, and it actually grew by 64%. So 2026, we don't know. But my guess would be that these analyst estimates of growth of 19% is going to be way below what actually happens. And, a lot of companies are treating it like this, like it's a gold rush right now. If they're a little bit late, they could miss the boat. And what that means is that all these dollars are finding their way to like real world things. These companies have to build out data centers and power banks and servers to all house the computing power that we need to run AI. And they need to do real world things to be able to accomplish this. So in 2025, we think that these largest hyperscalers spent about $350 billion on building out this infrastructure. Within a couple of years, by about 2030, the current estimate is that it'll be close to $550 billion. So this is a lot of money that has to find its way into the rest of the economy. Now, in the meantime, what's happening is that these hyperscalers are having to eat into the money that they generate to be able to pay for all of this. So again, we're looking at a lot of these same companies, Apple, Amazon, Google, Microsoft, Meta. These have been companies that have been able to grow earnings really substantially and have had very, very good free cash flow margins. And so, this is a big contrast to like the dot-com era when you had a lot of these dot-com companies that like traded off of eyeballs rather than actual earnings. Some of them didn't even have sales. But in this case, these companies have actually been able to grow earnings quite substantially. But what they're spending in CapEx is outpacing the amount that their earnings are growing by. So what you see here are free cash flow margins that are starting to dip. And this trend should continue as those CapEx numbers start to increase. So this is where the tension is going to come. How much money can these companies spend to make it worth building out all of this infrastructure? In the meantime, what we're seeing is that CapEx is really driving a large portion of the US economy. So when we look at GDP accounts for like tech and software, what we see is decent amount of increase and likely to continue increasing going forward. And if you look, that's particularly in computers, software, and then there's everything else. So that dark line there is what we're seeing about a lot of this AI spend. You can see that definite tick up at the right, but then gold, everything else in the GDP accounts has really subsided and is pretty flat. Now this year, the OBBBA provisions for CapEx kick in. And what that means is that a lot of companies are incentivized to spend more now because they get to write it off of their taxes. So while last year, all of this CapEx spend has been driven by these AI-related hyperscalers, going forward, we think what we'll see is a lot of other companies in different sectors, maybe smaller companies, will start to accelerate some of their own spending, not just for AI, but in general, we'll see CapEx increasing and we'll see this kind of more diffused. One thing to keep in mind as we think about opportunities in the market are valuations. And so often we'll have a chart in here showing that valuations in the S&P 500 today are very high relative to history. We're looking at highs close to where we were in 2000. Now, there's a lot kind of under the hood there. And so one thing to kind of keep in mind is on the left, what we have are what we call CAPE ratios. So this is a way of identifying valuations on a fairly like long-term basis. And we have the that valuation measure along the bottom, or that CAPE ratio along the bottom. And then on the top is what happens to the market 1 year later. So for instance, if today's CAPE ratio is 30%, your likely like forward return can be anywhere from 60% to negative 20%. So there's a really wide variation. If you look over to the right, we're taking those same metrics, but looking at what happens to stocks for the next 10 years. Left is 1 year, right is 10 years. And you see all of a sudden, all those dots kind of come together, meaning that there's a much tighter relationship between your valuation today and what your returns will be in 10 years. So what does all this mean? All this means is I often say valuation is a terrible timing tool. Valuation does not tell us that the market's going to turn down tomorrow. But valuation is a very helpful indicator of how much the market will grow sometime in the future, 10 years in the future. So what we need to think about is that returns from here over the next 10 years are likely to be lower than what we've seen in the rear view mirror. And because of that, we want to make sure that we have exposure to other areas of the market that maybe don't have those same high valuations. The good news is there are plenty of places to choose from. One of those places is looking outside the US. So if you remember earlier, we started off talking about how emerging markets and non-US developed markets have done better than the US. These countries have spent many years sort of underperforming the US. Here we're looking at the gold line is S&P 500. The dark line is MSCI X World, MSCI World X USA. So it's taking all the other companies in the world, pulling out the US. And so you can really see how those two compare against each other. And you can see that big dip early in the year when tariffs were actually before tariffs were announced, and then into that tariff where US markets underperformed, but then non-US markets sort of had a much more even trajectory over the course of the year. And similar to the earlier discussion, but when we look at valuations, non-US stocks have the advantage when it comes to valuation. So if you look that second from the left, that blue bar is looking at the range of valuations in each of these markets. The line is the long-term average. The blue dot is where those valuations stood as of the end of last year. So the US is at the high end of its range of valuations, and it is well above its long-term average. Now look at somebody like emerging markets. That range of valuations is much narrower, but that blue dot where valuations are right now is pretty close to long-term average. So it's really the US market that's driving those really high valuations. Other markets are still higher than average, but not by nearly as much. So again, as you try to think about the impact of valuations on your long-term returns, making sure that you have exposure to non-US markets is a really important way to sort of be able to capture those additional returns over time. Let's talk for a moment about fixed income. Here too, there have been some like interesting trends in that riskier types of bonds have done better than other types of bonds. So typically we think US investment grade corporates, these are going to be really large companies like Apple and IBM who are borrowing money. They often don't need it. They often just sort of like have it there as extra. And then high yield, which is the blue line, these are companies that are seen as a little bit less creditworthy, maybe smaller, maybe more concentrated or volatile businesses. And these lines in specific are looking at corporate spreads. So what's the difference between how much yield you get on a government bond versus a corporate bond, or a government bond versus a high yield bond? Generally, when these lines are lower, it means that the market is feeling pretty good, right? I'm not going to require this high yield company to pay me a really high interest rate because I feel pretty good about their ability to pay me back. So as this line comes down, that tells you the market is feeling very confident in these companies' abilities to repay their loans. But what that also means is that investors are not getting as much of a yield as they have in previous periods. So it means you have to think about that trade-off between the absolute yield that you're getting on a bond versus the amount of risk that's embedded in it. I want to touch on, we got a couple of questions like before the start of the webinar on geopolitical risk. And so I wanted to be able to address this. These are hot off the presses, so they don't look as pretty as the others. I was just on my Bloomberg terminal earlier today, kind of putting these together. But you know, if you've been following the headlines, there have been a lot of I think headlines focus on geopolitical risk a lot more than we've typically been used to. And full disclosure, I have my undergrad and graduate degree in international politics and worked in this industry for a number of years before I came to Wall Street. So this is a topic that I find very, very interesting. And so when I am able to kind of bring it into my work as an investor, I always find it really interesting to dig into. That said, as much as I think it's interesting and it's important, I think a lot of times what we see is that geopolitical risk can rise, but it really doesn't impact US markets in particular. We are very lucky as investors here in the US to be pretty well insulated from what's happening in other parts of the world. And again, not that it doesn't matter, but you have to be watching markets very closely to understand when something boils up to a situation where it does matter. So that's one thing to think about. Another thing is that, like, throughout my career, geopolitical risk is always present. There is always the risk of a conflagration somewhere. And so, my job is always to kind of keep track of all of that. And then again, to be very careful about identifying when we think it's going to boil over into US markets. So here what we're looking at are two measures of geopolitical risk. On the left is they're looking at like different newspaper articles for certain keywords to indicate that the media is more focused on these types of risks. And so what you'll see there is a definite jump up over the last like year or so in terms of risk. And we're getting close to kind of where we were. Well, if you look that big spike up, that was 9/11. So we're not quite at those heights, but we're getting kind of close to there. So there's a lot of focus on a lot of changes on the global stage. On the right is specifically looking at US economic policy uncertainty. It's hard to tell from this data, but when tariffs were announced, we spiked up to the highest level that we've ever seen. And we've come down a fair amount since then, but safe to say, like, policy uncertainty is a good bit higher than where it had been. But then we have to look at the markets and see what the markets are telling us about what they care about. And that tells a little bit of a different story. So these are a couple of indicators that I'll typically like pull up quickly to have a sense of what the market is pricing in and paying attention to. So on the left is you'll hear it called the VIX. It's the volatility index, how much investors are expecting the market to move around in the future. And what you'll see is that it spiked up a little bit, but then came back down. So this is in pretty muted territory. The MOVE index essentially does the same thing, but looks at treasury markets. So this is often used as a proxy for volatility for bonds. And you can see that coming down pretty substantially. Then on the right is oil. So oil is the most common way that political risk outside the US makes his way to US shores. So think about the oil embargoes of the 1970s, right? So a bunch of oil producers essentially cut off supply to the US of oil, sent inflation shooting, sent economic growth down, a huge amount of uncertainty. And in fact, like, that experience was so jarring for most Americans that led to this huge investment in building out oil production in the US, such that today we're actually net neutral. We produce as much oil as we import. So these can be like really, really jarring events. So that said, and another example would be like when Russia invaded Ukraine, you saw oil spike up initially, but then as the issues seem fairly contained, again, this is not to say that it's not hugely impactful, but at least from an oil market perspective, those oil prices started to come back down again, actually fairly quickly. So these are all long-term charts you can see, but Brent crude oil, this is the oil that comes from Europe, so it's more impacted by geopolitical events versus West Texas, which has had other impacts because of Venezuela. But what you see there in general is oil prices coming down. So oil markets are not worried about supply of oil being cut, and they're not worried about economic growth around the world being cut. So all of this is to say, I just wanted to give you a sense of kind of like how we're looking at the market day to day, and trying to size up what's going to be important for returns. So I'm gonna finish on what is often my favorite slide, and then if we have any questions, happy to kind of start to take those. But I think this is so important. Like, I love my job, and I love like trying to figure out this ever-changing puzzle piece. But it can be really easy to get lost in the weeds. And that's why I love this, because this is a look at these major asset classes for over 200 years. So you'll see this data was put together by Professor Jeremy Siegel. He's a legend in this business. He originally put this data together in the 1980s, back when spreadsheets weren't really a thing. So I'm sure he had a lot of graduate assistants who were kind of doing this by hand. But they were able to put together prices for these asset classes going back to 1800. And then they were able to take out the impact of inflation. Doing that allows you to compare different periods. So for instance, in a high inflation period, you might have asset prices that are going up a lot, but you're not actually able to buy more eggs because the inflation has sort of driven those prices up. So taking inflation out of the equation and looking at just what we call real returns allows us to be able to see a more like for like performance of these different asset classes. So up top, you'll see stocks. Blue line is bonds. Then we have bills, gold, dollar. And what's really remarkable is the consistency of the return in stocks. So you can see that red line kind of up and to the right. And when Professor Siegel and his students put this data together in 1980, the average real return of stocks was, I think, 6.6%. We now have 45 more years data to be able to add to that. And the real return of stocks continues to be about 6.6%, right? So that talks to the consistency of this. Now, 1 year to the next, you'll see those stock returns move around that red line. So that's where you need to be really careful that you're not getting too drawn in to look at the very near term. You have to step back and kind of think about what are the long-term opportunities that we have. So let me, and then I'll just call your attention to the note from the quote from Professor Siegel on the bottom. Stocks are the most volatile asset class in the short run, but the most stable in the long run. And that is how people build wealth reliably over time. So I'm going to pause there. I know I've yammered on a lot. I already see a bunch of questions in the chat box. So why don't we spend a few minutes going through that? And then please feel free to add in any additional questions as they come up. So let's see. Given the likelihood of an AI bubble, what are your thoughts on shorting the market? So it's interesting. I spent a bunch of years at a hedge fund where a big part of my job was identifying areas to short in the market. And it is extremely difficult to do because you have to get timing right in addition to the fundamentals. So that's the quick answer, which is that most people lose money when they short the market, even if they're right about the fundamentals. But specifically about how I feel about the market right now, I actually think there are a lot of really positive signs in the market. The economy is growing, job market stable. The Fed is providing tailwinds for the market by continuing to cut interest rates. Global growth is fairly stable. So there are a lot of these things that we look at. Oh, and by the way, like corporate earnings continue to grow. So when we look at all of the traditional kind of foundational measures of the market, they're still looking really positive. And of course, momentum is quite positive as well. So I feel really good about the market, but I would make sure that you have exposure to really a diverse set of asset classes so you can ensure that you capture some potential returns outside of where the market has led so far. Looking at the housing market based on historic trends, are we likely to regain recent losses by 2030? So it's always hard to like put an exact date on it, but here's the way to think about it. So heading into the global financial crisis in 2008, we had housing prices that just, went off the charts. And I remember sitting in meetings in like 2006 and 7 and hearing analysts say, well, the US has never seen the value of housing go down year over year on a national basis. And I like wanted to tear my hair out. I was like, well, just because it hasn't happened before, it doesn't mean it can't happen in the future. And when you have asset prices going like this, it's only natural to assume that you could see some downside in prices. So sure enough, that's what we had. And it was very, very destabilizing. Since then, with really low interest rates, we've seen housing prices increase and increase yet again. Interestingly, even though housing prices declined a lot during the financial crisis, they came back within, depending on where you are, within anywhere from like 3 to 10 years. And housing goes through long cycles. all of that's to say, fast forward to now, housing prices have increased yet again. We have affordability that's really low. People are having a hard time getting into homes, and we've seen some markets that have declined. I live here in Austin. We're seeing declines of about 10% from the peak, but we're also 50% up. So housing is a long-term game. 2030 is 4 years away. And so I think there you're going to see very different dynamics depending on what city that you're in. So we're still seeing cities, for instance, in California, where prices continue to increase. Other kind of hotter cities like Austin and Phoenix have come down more. So depending on where you are, you could for sure see housing prices kind of get back to those previous peaks. But it'll really rely very much, especially in that short period of time, will rely very much on what market you're in. All right. Can you talk about why non-US stocks have outperformed, and do you expect that to continue? So part of the outperformance of non-US stocks was the US dollar underperforming. So we talked about that. That's like a little bit less than half of the reason why non-US stocks outperformed. The other piece is, I think, similar to the same reasons why the US dollar underperformed, where there was a lot of policy uncertainty in the US and people were looking for other opportunities, other areas that were maybe going to be a little bit more insulated from, let's say, like tariffs or other policy uncertainty. And then I'll also add those markets have been have underperformed for many years relative to the US. And then when we look at, for instance, in Europe, a large portion of the outperformance came in defense stocks. So defense spending has really been ramping up, and that's finding its way into like other types of defense and industrial companies as well. Thoughts on if Supreme Court rules that the president can fire the Fed chair. So I probably don't have any better read on the likelihood of the Supreme Court's running. If there are any lawyers in here who have been following it closely, they're probably going to understand better. Based on reading the sort of account or analyses that I've seen up to now, it seems likely that the Supreme Court will push back on this and say that the president cannot fire the Fed chair. But either way, I think the Federal Reserve has often been seen as a very different type of government institution relative to some of these other government agencies, in that its independence from politics is part of its strength. And with that, there are more legal protections for those individuals who run the Fed versus others. The market has really sort of come to expect that the Fed will remain independent from political pressures. We have a couple of other examples where Fed chairs have succumbed to political pressure and it hasn't worked out so well. And so I think markets right now, as we sort of like read the tea leaves, markets are assuming that the Fed is going to continue to be protected. So it definitely bears watching. As I mentioned earlier, we have a higher degree of political risk and political pressure on those individuals relative to what we've typically seen, but it's not wholly unprecedented. And so right now the markets have really taken it in stride. So a couple of questions about market into next year. Do you see a market correction anytime soon? Or what do you anticipate the return to be in 2026? So anybody who tells you what they think is going to happen in the markets over the next 12 months has a high degree of guessing in there. Because a lot of different factors go into what direction the market goes in. I mentioned earlier, as we look at the fundamentals of the market, how much can companies earn? How supportive is the interest rate environment? Are people still working and spending? All of those suggest that there's really good foundations for the markets going forward. That said, I always say, like, you should always be prepared for a market downturn. Downturns happen, and let me see if I can remember, like we tend to have 10% corrections at least every year or two. Bear markets tend to happen every 3.5 years on average, but they can happen more frequently than that. And then think back to, this stock. We have bear markets and corrections all the time, but the market is really consistent and coming back again. So as you build a portfolio, you should be ready for a downturn. And that's also why you should own a variety of different asset classes that help kind of smooth out that ride. So with that, let me see, there's one more. Is there a debt bubble around all the investment in AI? Asset lifetimes seem to be relatively short relative to the CapEx needed, and there seem to be questions around who owns these debts. So this is a really important question. We've been doing some work on this to kind of unwind all of these different deals that have been happening. So to provide some quick context, um, we mentioned earlier that $350 billion that the hyperscalers are spending in CapEx. That CapEx is going to data centers, power, all that other stuff. Um, but what we found is that they're getting more creative in how they pay for it. So for instance, I think it's Meta who created an SPV, so a special purpose vehicle to be able to, and then that special purpose vehicle borrowed a bunch of money and then is going to build out the data center. But what that means is that it doesn't sit on Meta's balance sheet. So it's a little bit more hidden. So over the last year or so, we've just started to see these like call them creative financings, which is always a bit of a red flag, right? We don't want companies to be hiding the amount of debt that they're having. The good news is that all of these hyperscalers have enormous cash generative power, right? So if you remember, we were looking at those free cash flow margins earlier, well above average within the S&P 500. So right now, don't love the fact that all this creative financing is happening, but there is a lot of cash and a lot of earnings that are behind those. So it's something that we're watching very closely. And you also mentioned like asset lifetimes. So the depreciation schedules on these allows companies to sort of depreciate the assets over a long period of time, even though they have to be replaced fairly quickly. So again, I think this is something that the market is going to have to contend with, but not in the very near term. So with that, I just want to thank you all. It's been lovely spending time with you. I love all of these questions. Super interesting to hear what's top of mind. If you are interested, we will have this available as a PDF. And we also have weekly commentary if you're interested in following us. And as I often like to say, invest wisely and live richly.